And I have my trading warrior brother, Luke Gromen, here today. Luke, how are you, my friend?
I'm doing great, Dale. How are you today?
Good. Great to have you here. I mean, we have a lot of things going on, and I'd like to start with, I was going through your stream. I prep before I talk to people, and I don't think we've ever covered Bitcoin and what your view is, but you've done a few interviews, and it looked like Bitcoin was one of the major topics. What's your view on Bitcoin? Are you a believer in it? And how did I miss that?
I am not a crypto guy. I am a Bitcoin guy. I look
Okay.
at Bitcoin very simply. I think it's really interesting that the SEC has called Bitcoin a commodity. It's the only one that is not a security. It's a commodity because, in my view, Bitcoin is simply a neutral reserve asset
Okay.
with an energy tied to it. The proof of work algorithm, where you have to expend energy to receive the Bitcoin reward, means it is tied to energy, and so I think it very much resembles a digital gold in that way.
Okay.
It's not used for anything other than, in my view, a store of value for people, a store of value with extraordinarily high volatility
Yeah.
that you need to have your position scaled appropriately given that. But that's how I think about Bitcoin.
Okay. I mean, you can't beat its portability, can you? I mean,
No.
in World War II, people stuffed diamonds in their socks or whatever to get across borders to escape whoever their enemies were. And it's certainly hard to carry a silver coin bag pre-65 silver coins. You could get a hernia doing that. So as someone told me, all you have to do is really memorize about 13 words, and you can be anywhere in the planet and access your wealth. What else can you do that with?
It's so powerful, and that's not my base case, but I do think it's very important that there is no other asset where, like you said, if worst comes to worst, all you take is the shirt on your back, you memorize your passphrase, you go somewhere else, you eventually start working again in some capacity. You save up enough money to buy a phone, you download your app, you put in your password, and boom, there's all the money that you worked your whole life for, right there,
Yeah.
stored still, and then you start over. And so it's not something Americans spend a lot of time thinking about, but you go pretty much anywhere else in the world with sort of either more recently, or you talk to older people in other parts in the world, and they understand implicitly the power of that.
Yes, I mean, and we even talk about it. We talk about being in the right asset classes, right? And to
That's right.
being diversified in asset classes, but most of us have no political diversity.
Yeah.
Okay, should things change, and as they are changing, and people that have come from other countries that have had to deal with authoritarianism and freedoms and speech being taken away, and things that people say are coming to America, don't understand that you also, besides your assets being diversified, you need political diversity. Do you ever think about that? Because I know, you're here. Do you ever think about maybe I need to do that to protect myself and my family, is have some
Uh,
political diversity?
I have thought about it. It strikes me from time to time. The way I think about it is there are sort of finite, hard signals in my mind that, if I saw them occur here, would sort of be like a trigger
That's
switch to saying,
okay.
okay, something has changed. Now, I need to do
Right.
X, Y, or Z. For the
Yeah.
most part,
You're going to ride it out here.
I think it's the
I
best
see
place
it.
to be. I think it's
Okay.
the best place to
That's
be.
encouraging. That's encouraging that this is going to be the best place to be when we get to your end game. And I want to ask you, Luke, and this has been a pretty severe correction, and I don't really call it as dollar related, but who's selling the gold to take it down from 1960 to 1800 here? Any
I
idea?
don't know. I really don't know. I think it's probably sort of the financial traders who have gotten, hey, hotter inflation, Fed's going to 6, Fed's going to, 5.5, 6. And that's sort of the reaction I think we're watching. I think it's very short-sighted in nature. I understand why it's being done, because what the higher for longer or the big flip or whatever, okay, I get it. That's the financialized trade. That's the short-term trade. You sell gold. What the big flip, higher for longer, that's sort of step one. Step two that they have not gotten to, in my view, in terms of the perception, is the oh my God phase of what 6% Fed funds actually does to the US fiscal situation. And the
Okay.
last thing you want to be doing is selling gold at 6% Fed funds, because you're now talking about $1.8 trillion pro forma in interest expense, another $3 trillion in entitlements. So that's $4.8 trillion. All-time record tax receipts were $4.85 trillion last year. You needed 8% CPI to drive that. You needed an everything bubble to drive that. Both of those things aren't the case anymore. So your tax receipts are already falling. They're down 7% on individual tax receipts year to date, and
Okay.
fiscal year to date. January was down 9. They're going to get worse because there's going to be a lot less in capital gains coming. California, for example, was down 42% year over year in January in tax receipts.
Wow.
So
Wow. So
you've
we have
got this.
the crunch is here. We're now entering the end game, because what really kept it going, besides the Fed and and Congress with fiscal stimulus, was tax receipts while the economy was doing okay.
Right.
And now it's not happening, and so they're squeezed. You put it as a binary situation. The Fed has to make the decision to either let the dollar go or default on its debt, that there's a really only are two choices. Can there be a muddling of doing both and rotating them from time to time, so nothing happens all at once, but they try and stretch it out? And don't you think when it comes down to it, they're going to make the dollar the sacrificial lamb rather than default on the debt?
Absolutely. The dollar will, in the end, be thrown under the bus. Can they string it along and muddle along? They've done an admirable job so far of some version of that. The challenge, and this is the downside of leverage, right? This is, 40 years of Reagan proved deficits don't matter. Reagan proved that debt doesn't matter. Well, yeah, for 40 years, that's right. And then all of a sudden it does. And so when you have 125% debt to GDP, when you have deficits at the absolute peak of the economic cycle, with CPI doing what it's doing, with everything bubble doing what it's doing for helping receipts, when your deficits are still running 6-7% of GDP, which is way worse than it was at pretty much any other depth of a recession going back 40 years, with the exception of COVID. That's the problem, which is to say it's no longer a dial, it's a switch. That much leverage, it's just a switch. If you're in a recession, you're in a debt doom loop. If you're growing, you're inflating really rapidly, and or certainly above the 2% targets. And so that's the fundamental problem they have. They've got some other ones layered on top of that, but that's why when you look at the chart that I showed that said that on Twitter, which was the U.S. deficit against inverted unemployment, you've only seen a gap like that in that chart 2 other times in history: 1967 and 2019. And 1967, the next 12 years were pretty inflationary. The U.S. was, you had a gold market accident 6 months later. The U.S. was off the gold standard 3 years later. After that, you had the inflationary 70s. It was very, very inflationary. Some of that was driven by the oil crisis, but the tinder for the inflation of the 70s, and probably some of the kindling of as well, was really these twin
Arthur
deficits.
Burns.
Yep, Arthur Burns, and the twin deficits, right? That chart
Yeah.
shows that deficit rising while unemployment was tight. Why was that happening? Because of guns and butter. We were in Vietnam. We were doing great society. We're spending a bunch of money. A lot of it was borrowed. Employment was tight. And then boom, you have sort of the inflationary catch up. It happened again in 2019 in a little reverse order, right? We had the COVID, we had that gap blowout where deficits are rising sharply. Unemployment is very, very low. You have the COVID crisis, which, sends things down and then sends the printing into
The
hyperdrive.
bazookas.
And then we get the real inflationary back. So it's an order of operations question, but it's neither case there was really a muddle through. It's either sustained high inflation or you can get a decline, but it's going to be a sharp decline, and then that's going to force them to come in and uber print again like they did in 2019 2019 20 and 21.
Is there anything in the shadow banking system, Luke, that portends anything? Because I talked to some smart guys, and the shadow banking system in 2008 was half the size of the commercial banking system, and it's grown to 1.5 times the size of the commercial banking system. An example would be somebody like BlackRock would be in the shadow banking system, right? Or SoFi, or do any of these things in the shadow, as big as it is, could the problems come from places like Blackstone? I mean, they had problems with redemptions last year, and actually they took on a partner that basically saved Blackstone. It was almost like a rescue, a bailout for them. When the tide goes out and rates keep going, do you think that we could see some things as far as solvency in shadow banking as well as what we have on the books with regular banks? Aren't we due for a solvency part of this drama? Isn't that the third act, solvency?
It is on the shadow banking. The short answer is I don't know.
Okay.
You've seen a lot of it there's a lot of asset-backed lending, consumer asset-backed lending, right? And so we just had, for example, this subprime car lender,
Oh yeah,
last week was trying to do a bond deal. Yesterday they just closed the doors. Not necessarily a huge deal in the grand systemic side of things. You've had a couple of very big players doing what we used to call on the sales desk jingle mail, right? On some major downtown office buildings, I think in LA and in New York, where you mail the keys back to the bank, jingle mail. So there are some problems there. To me, I think when to get to the solvency part of this problem, it ties back to my initial point, which is I think we have to go back and remember we had a stock bubble and it burst, and we kicked it upstairs to the banking system by creating a housing bubble. It burst. We kicked it upstairs to avoid a problem, or for the bailout, up to the sovereign level. And to me, that's where really the solvency concerns lie, which is, when we hear and see these things about commercial real estate, if they keep taking rates up, what we're going to see is a nonlinear decline in tax receipts and a nonlinear rise in treasury issuance and in other sovereign issuance, where interest rates are going up and tax receipts are going down nonlinearly. And now you're going to have to issue more treasury issuance into because deficits are rising countercyclically into a weak asset demand environment. And that's where I said before, where you either get a debt doom loop, because now you're going to have a nasty recession where rates are rising, which is not something we've ever seen in America in any of our lives, but it's something that happens all the time in any developed
third world countries.
It's a third world country problem. Yeah, exactly.
You bring up sovereigns, and when everyone was kind of wrong-footed in the 10-year, when we were around 330, and everyone was saying, well, rates are going to turn. There were a lot of failed auctions in the 30-year. Rick Santelli would report and give it a D- on the 30-year. No one showing up. There's no bid, very little bid to cover on these 30-year auctions. So it's already showing up. We're having failed auctions on the on 30-year paper right now, aren't we?
I would say the short answer is they've been the strength of the auction has been tied to the inversely correlated to the strength of the dollar, which is to say, as the dollar was getting stronger and stronger last fall, up to 113, 114, you were seeing 10-year auctions with 2 and 3 basis point tails. And exactly, I had a couple different senior hedge fund people reach out to me. Well, that was effectively a failed treasury auction, de facto. You saw the gilt market blow, the UK gilt market blow up.
Right.
You were seeing
JGBs.
The JGB market, you were seeing, the move index of volatility for the treasury market was at 160, last fall. The creator of that index said anything over 150 is a sign the Fed has lost control. So you were seeing exactly that. Now, as soon as the dollar went from 114 to 101, you had this string of really, really good auctions in January. Almost every auction stopped through. Very, very strong. So now the dollar has bounced from 101 to 104. Of the last 5 auctions, 4 have had a tail, decently sized. It's taking less of a strong dollar to start bringing this back. So there's this problem that international players cannot get involved with treasuries if the dollar's too strong, because the strong dollar is putting pressure on asset prices, solvency, economic growth globally. So U.S. policymakers, global policymakers need to get the dollar down to prevent a treasury auction. I mean, a really bad outcome.
Okay.
But at the same time, getting the dollar down is feeding inflation, which is also going to create a bad treasury outcome. So you're getting to this situation
there really is no way to resolve it without pain.
Like what, it's basically how do you want the treasury market, how do you want treasury yields higher? What do you want the excuse to be? Higher inflation or crappy auctions? The issue ultimately, when you back it up, it's a supply demand issue. And nobody wants to talk about it. The U.S. is issuing too much paper. Why are we issuing too much paper? Because we're 125% debt to GDP. A third of it rolls every year. And we're also running 7% deficits at the peak of the cycle. And our tax receipts are rolling over because our tax receipts are tied to asset prices on the margin. And oh, by the way, rising rates hurts asset prices.
Okay, I wanted to ask you, with there's this expression, Luke, that anything in a bull market, anything that could go wrong doesn't. And in a bear market, anything that can go wrong does. Do you think that I know a lot of people are looking for some credit events this summer. Do you think that since we are in a bear market, at least in my view, we are, that we could end up with a self-inflicted wound? Because no one thinks that we won't go ahead and raise the debt ceiling. The narrative it'll be theatrics, but at the end they'll do it. But if they drag it out, I'm reading that we run out of room in June for the extraordinary measures we're taking right now to run the government. And this tax season is very critical. Could we end up with a self-inflicted wound where even if we do go ahead and raise the debt ceiling, that we get downgraded again by Moody's, which wouldn't help either?
I don't know if we go to a full downgrade, but I do think this debt ceiling has a really good chance of being a lot more eventful than what we've seen. That I think people are I agree with you that people are too complacent about this. It's a different geopolitical environment. It's a different inflationary environment. The tax receipt situation. I mean, if I recall, that extraordinary measures was going to take us through September, like 3 months ago, 2 months ago, and it keeps coming forward.
And an acrimonious political environment, which
acrimonious political environment. Exactly. So, and I think it's a wildly underappreciated dynamic. But when you have what we had last weekend, which is Blinken on the tape talking about sanctions on China and doing whatever it takes to Ukraine, Kirby, Sullivan, Yellen, I don't think
what's Yellen doing? What's Yellen? I saw someone sent me a picture of Yellen in Ukraine with Zelensky. What's she doing there?
I don't know, but I can tell you what they're doing that I don't think they realize they're doing, which is kicking the legs out from under the treasury market. Like
Okay.
war is inflationary. Like,
Yeah.
and this to me is maybe the biggest perception out there is I hear, well, if there's a war, everyone's going to run into treasuries.
Yeah. Yeah.
There's
I
a
saw that.
war with Russia or China or
That's
even
the other
an intense.
casualty.
Oh my God. Like the
Yeah.
last thing you want to own are bonds of any stripe. You want to own something. I mean, there would be
Tangible.
nothing more inflationary than that.
Okay.
Yeah,
Got it.
it would be catastrophic. And I don't think they understand that. I think they think this is, I mean, even if you forget about a World War II type scenario of domestic government finance, you go to Vietnam. Like, find me a serious conflict with a serious partner where bonds bought you more real world goods at the end of it than at the beginning of it. And
Great point.
you can't find it. You can't find it. So they've got to be very, very careful. And they're like bulls in a china shop. I don't think they understand. They're sitting in a house that's made out of sticks that have been soaked with gasoline, and they're just sitting there flicking matches over at Russia and China. It's not smart.
Yeah, and you bring up China, and you do what you call a blast from the past, where you'll go back and come up with a tweet that maybe was 10 years old. And I saw one from, I think, 2013, that China owns 5% of Ukraine. No one knows that, Luke. Do they?
No.
So why wouldn't they be allies with Russia? Maybe they could get a bigger percentage, but they really do own 5% of Ukraine.
That's that they at the time it said 5%. Then the Ukrainian government came out and said, well, it's not technically 5%. It's, they're just here. The big picture is for me is people like, well, the Chinese could sell our treasuries. I'm like, I agree with the people say it doesn't matter because the government, U.S. government could buy them all right away. My bigger point is the Chinese have been way ahead of this. They've been selling dollars, swapping treasuries for farmland, copper mines, oil. And then we can get into a discussion of, hey, can their military hold what they have swapped their dollars for? That's a separate discussion. Again, very inflationary. But the discussion of what if China sells treasuries, that ship has sailed. The horses are gone. The barn doors have been closed behind them. Whatever metaphor you want to use.
They should be more worried about when the Fed sells treasuries.
That's the problem. Is the Fed's going to sell them? Treasury's going to sell more. Mom and pop. It's very one-sided. And the more the Fed raises rates, the more they have to sell. So and the more the balance sheet capacity to buy them shrinks domestically and globally.
So, we've been talking about this for a while. Do you have a feeling now, as you've watched all, your narratives progress, that we're getting closer and closer to when John Q. Public will notice that there's something wrong? Or when do you think that might become obvious? Some people are saying no landing now. Some people are saying, we're not going to have a recession. When do you think some of these things that we've talked about in the last 30 minutes are going to show up on people's radar screen and people be aware that we have problems here in America?
I think it's going to be a combination of sustained inflation and the passage of time, where it changes mindsets, right? So I'm in Cleveland, Ohio. Like, home prices in Cleveland, Ohio, they never participated in the upside. They still sort of fell a little. There's just been, and you're starting to see home prices here. Like, there was one near me traded at a slight premium in 19, and then it sold for 60%, 60% more 3 years later in 2022. Those kind of things where people go, whoa, that's different. And then if it happens again, it's that kind of thing where suddenly the mindset changes to, okay, this is inflationary. This isn't going away. And it further indicts the credibility of the policymakers. Unfortunately for U.S. policymakers, and I think it's a global phenomenon, but in the U.S., where I think there was this really ironclad faith in some of our institutions, I think they've suffered greatly, that credibility, over the last 2-3 years in particular, more broadly, the last 10 to 20, with some of the decisions we've made, how they were spun and how they played out. So I think it's a process. I don't think it necessarily is an event. But the challenge with that for policymakers is you don't know when, what the straw is that breaks the camel's back, right? When, hey, we're number one, and then we're running out of Afghanistan, and then we're, locking everything down, and then, hey, one shot to stop the spread, two shots to stop the spread, three shots to spread. Well, it's still spreading. Sorry, we shouldn't have locked you down in the first place. Mask never worked. But all these things indict credibility, and I think if you keep an inflationary environment within that, and again, it ties back to my first point of like, if they also crash things trying to fight inflation, that doesn't help their credibility either. Like I've said multiple times since last summer, where we began reading, Powell is saying he doesn't want to be the next Arthur Burns. He doesn't want to be the next. He's worried about his legacy. I appreciate he's worried about his legacy. My feeling is that if he truly understood the situation he was in, he would have resigned with clarity at the end of 2021, early 2022. With the insider trading scandal. Hey, failure to control. I'm taking a, because his legacy is going to get hit one way or another. He's either going to have high inflation, he's going to be Burns, or he's going to be Ben Strong. He's going to over tighten the world into a Great Depression. I mean, it's really, he's on knife's edge. It's a very difficult situation because of the leverage and the situation he has to try to manage through.
Okay, well, I think that he should have had your newsletter back then, and maybe would have had a different view. And Luke, best way for people to subscribe to your newsletter, The Forest from the Trees.
Absolutely. You can check us out at our website, fftt-llc.com. A couple different options, both mass market and institutional options available through there.
Okay, so here you are, guys. Keep Luke in mind when you're thinking about the future and what side of the market you want to be positioned on. And Luke, always appreciate you coming here and talking about things that aren't pleasant, but something that we all are going to have to face. Thank you, buddy.
Yeah, absolutely. Luke, thanks for having me on again, Dale. It's great catching up.
All right, Luke Gromen, everybody. Follow him at Luke Gromen and check out his writings. Adios, Luke. Thank you very much.
Take care. Thank you, Dale. Have a great day.
All right, and that's a wrap, everyone. You could join the team in about 15 minutes on the Morning Edge. Hope you enjoyed Luke, and we'll see everyone tomorrow. Good hunting today. Looks like they're trying to turn the metals here. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.